As you can see today, Travis is not here. He ghosted me, said something about a vacation. Told him we don't take vacations around here, but
with Steve gone, frolicking in the Ozarks, we thought we'd change things up a bit. Being as we just finished the first half of 2025, let's take a look at where we ended and what to think about during the second half of 2025. So on your screen here is the S&P 500, NASDAQ, and the Dow Jones Industrial Average. And as you can see, through the first half of the year, in April, with the tariff-induced volatilities, markets, fell quite a bit. But since then, given that some of those issues have been resolved and markets have gained some clarity, we saw strong recoveries coming out of those April lows, with the S&P 500, NASDAQ, and Dow finishing at or close to all-time highs. So good, strong recovery from those April lows in the first half of the year. Now, looking forward to the second half of the year, what should we think about? So first, a lot of things are driven by Fed policy and rate cuts, or the potential for rate cuts. What are interest rates going to do? Markets are going to be looking at that. Earnings resilience and margin pressures. Can companies continue their increasing earnings? And what will tariffs do or increased costs do to their margins? Top-heavy markets. What stocks are driving the returns in these indexes I just showed you? And how big have they gotten? And then geopolitics, always a wild card. So let's dive in here. First, Fed policy path and rate cuts. Inflation has been cooling, but that last mile has proven sticky. You can see here the consumer price index and the core consumer price index still above the Fed's targets of 2%. That last mile again proving pretty sticky. So what does that mean for rate cuts moving forward? If inflation isn't moderating, markets are pricing in 1 to 2 cuts before year end, and you can see that even the Fed Open Market Committee projections have cuts here in the future. But, tariff policy has clouded the outlook, and, with the potential for inflation to maybe go up from here and growth to slow, the path forward is less clear. So markets, even though they're pricing in 1 to 2 cuts, might not be right there. Next, earnings resilience versus margin pressures. We had a first half that was very strong. The second half is actually going to test the mettle of these companies, right? So if you look back, what were trailing profit margins on, call it the S&P 500, which is your large companies, the 400, which is your mid-cap companies, and then your small companies with the S&P 600, you can see, trailing profit margins. The large companies are doing a little better, even trending higher, where the mid and small, we saw earnings trending lower here. Looking forward, what do analysts expect moving forward? They still see, growth on the S&P 500, the large companies. The mid-cap companies still have a small downtrend, but those small companies, they're seeing some recovery there. If we do get rate cuts, that will ease some pressure on their interest payments on the debt they've taken out, and perhaps expand, their profit margins. So markets are going to be looking at that. One thing to keep in mind, though, is markets are going to get volatile here as you go into earnings season, because investors are going to reward, operational discipline, but they're going to punish earnings misses or guidance harshly in a market that's priced pretty close to perfection right now. So could give you opportunity to pick up some bargains. We'll see, but it will lead to some volatility in markets here moving forward. What's next? Top-heavy markets. It's interesting because we talk to people and they don't really know this dynamic is unfolding. So the Super 7 stocks, think your NVIDIAs, your Amazons, your Apples, a lot of those big tech names drove a lot of the returns in 23 and 24, but stretched their valuations, especially in names like NVIDIA, which has been a high flyer here. So if you look at the valuations here moving forward, the top 10 stocks in the S&P 500, they have a current valuation as measured by the PE ratio of about 27. The remaining stocks are only at 18, so they're theoretically trading a little cheaper here. And the S&P 500 is a 21 PE as a whole, which is above its historical average, right? So that's when people say the markets are trading rich. That's kind of what they're talking about. Now, that has led to top-heavy markets. The weight of the top 10 stocks in the S&P 500 is north of 36%. So you say, hey, I'm buying the S&P 500. I'm getting wide diversification. Well, 36% of what you just bought is in 10 companies. So be aware of that. And top-heavy markets, they're not unusual, but they do lead to fragile markets, or they can be fragile. They can be exposed to shocks, especially if earnings misses, as we talked about on the last slide, do materialize. So expanding your portfolio beyond the Super 7 and standard indexes continues to make sense here. Last, geopolitics, always a wild card. People are going to focus on it, but you can focus on it, but you really don't have any control of it, right? So if you want to gain some control over what you have going on, look at the things you do have control over. You have control over your asset allocation and location. You have control over savings versus spending. And you have control over, your health and somewhat over your employment. You don't have any control over market returns, geopolitics, effects on those, or what Congress is doing with the tax benefits and tax policy. You can focus on them. You don't have control of them. It might make more sense to focus on what you have control over here moving forward. So real quick, just to sum things up, Fed policy path and rate cuts. Markets are going to focus on the timing and pace of cuts here through the second half of the year. Earnings resilience and margin pressures. Investors are going to reward operational discipline, but they're going to punish earnings misses here. It's going to lead to volatility. Top-heavy markets, 36% of the S&P 500 is in 10 companies. It might make sense to look or expand your investment portfolio beyond those Super 7 and standard indexes. And last, geopolitics. You can focus on it if you want. It probably makes more sense to focus on things you have control over in your portfolio in life. So thanks for being with us this week. We look forward to talking to you next week.